Hi CS students, let's revise CA Final AFM Chapter 4 Security Analysis Practical Question 2. The closing value of a stock market index for the month of October 2007 is given below, and they've given closing dates and then index values, and you are required to test the weak form of efficient market hypothesis by applying the run test at 5% and 10% level of significance. Following values can be used. Now, before going into the question, the requirement is about testing the weak form of efficient market hypothesis by applying the run test. So let's see what is this efficient market hypothesis, what is this weak form, then what is this run test, then what is the level of significance. Efficient market hypothesis is nothing but all available information is already reflected in the stock prices. So the efficient market hypothesis says whatever price fluctuations happening in the market, it is based on some or the other information, and which the market will itself reflect. So let's say for a basic example, if let's say a public limited company, XYZ Limited or whatever, releases its quarterly results, and in the quarterly results, when we analyze, it has doubled the profits, and the news is made available to the public. Now what as an investor we do, we'll try to buy the stocks, right? So before the market opens, we were waiting for the stock, waiting for purchasing the stock, but the market price is increased from 100 to 130. Now when we try to buy, the crux here is the 130 price is already hiked up because of the information, because the investors, traders, institutions, they were already seen this news and they already know this news, and before we buying it, like big investors or algorithms or the bots which we use now to trade, right, this will automatically react to the news. So we can't beat the market, it doesn't work like that, right, unless and until we have some insider information or something which helps in predicting the prices. So that's what the crux of this efficient market hypothesis. All available information is already reflected in stock prices. Now this efficient market hypothesis have three forms of market. One is this weak form, semi strong and strong information. When it is in weak form, it says past information, the prices reflect the past information and there is no new information available or something. And when it is semi strong, then the prices reflect all public information, all generally available public information. When it is in strong form, then all info like insider information or confidential information, everything is reflected in the price. So we can short predict the price in case of that. In the case of a weak form, we cannot predict future prices based on past prices, and any technical analysis won't help, and prices will follow a random walk, means prices will be random because we will not be able to predict it, right? Now to test this, like how will we say that it is a weak form or semi strong or strong, right? For that we have this run test, which is a statistical tool, wherein the run test will tell us whether these prices are random or not. If random, then it is weak form and we cannot predict prices. If not random, then some technical analysis might work to predict the prices. Now the next thing is, what is this level of significance? So this level, the level of significance says based on the Z score or T score, and which is again a statistical analysis. We might have seen in our first chapter Z score and all, the standard deviation and the difference from the mean signifies this Z score table. So the level of significance is opposite to the confidence level. Now let's say if I have a level of significance of 5%, then that much it can go wrong. So it signifies I am 95% confidence in the result. What is the result of predicting the prices? So in our case, in this run test, I am 95% sure that whether this will be a random or not random, right? Okay, now we understood the basic terms of this efficient market analysis and weak form. Now let's dive into the answer. Now, in the given question, they are asking weak form of efficient market hypothesis by applying the run test at 5% and 10% level of significance. So, 5% is 95% confidence level and 10% is 90% confidence level. So, which will be good, right? Like 5% will be good because we have 95% confidence level, which will give us more accurate results. Now following values are given from the t table. So value at of t they've given 2.101 at 18 degree of freedom, which is how much the graph is expanded. That's what this degree of freedom is. Okay, now going to the question. Now since we need to find the randomness of this stock, right? So this run test signifies the price changes and the sign changes, like from whether the price increases or decreases. Now it is so simple that based on the given data, first the data has to be in sequential, the date. Now the data is already in sequential only, no need to change arrange or change arrange. The closing index has been given, daily closing index. So from the starting we have to see what is the price change. So from starting from 2800 it has reduced to 2780, which is a negative sign. Then from 80 to 95, which is positive. Then 95 to 830 positive. Then 830 to 760 negative. Like that we have to plot the sign of price changes. After that we have to see what is the total of sign of price changes. So how will we do that? So the price change, we need to see how many positive price change and how many negative price changes, and then how many changes in price. So first change happened here, which is negative. Then second change here from negative to positive. Then the third change here from positive to negative. Then fourth change here from negative to positive. Then the fifth change here from positive to negative. Sixth change here, and then seventh change here, then eighth change here. So there are total number of price changes is 8. This will be the runs. Actually there are 8 runs. As we can see, total of sign of price changes are equal to 8. Now positive changes, and the number of positive signs and negative signs. So the number of positive signs is 11. 1 2 3 4 5 6 7 10 11, and the negative changes are 8. Now based on this data we have to do the run test. So first we will be calculating the mean, then the standard deviation. So there is a specific formula to find out the mean in case of this run test, and to find out the standard deviation in case of the run test. Now when the total sign changes will be considered as R, and the number of positive changes will be N1, and number of negative changes will be N2. Now after we applying when we apply this values which we got in the mean formula, then we are getting a value of 10.26, and the standard deviation is 2.06. Now since too few runs in this case would indicate that the movement of price is not random, so we are following a two-tailed test. So what is this two-tailed test? From the mean, So two-tailed is nothing but from the mean we are taking on the both tails, one to the positive end and one to the negative end. So in our case, since our we have to take the lower limit also and then upper limit also. Since the level of significance is 5 percentage and 10 percentage, both we have to calculate. First we will go with the 5 percentage. For that, the mean minus the value of t multiplied by the standard deviation. We will have the lower limit, and the same goes with positive. We have to add the standard deviation multiplied by the uh, value of t. We'll get the upper limit. Now as we can see, the lower limit is 5.932 and the upper limit is 14.588, and our runs are 8. So which is within the limit of this 5 and 14. Same case goes with 10 percentage level of significance, wherein the lower limit is 6.688 and the upper limit is 13.832. Even here also the runs which we calculated 8 is within this limit. Thus the market reflects a weak form of efficiency. As seen, R, which is 8 in our case, lies between these limits. Hence the market exhibits weak form of efficiency. Thank you.